In life, we run across some things that are common and some things that are preferred. The same holds true in investing. In this week's U.S. Bank Economic 360, U.S. Bank Vice President and Senior Portfolio Manager Mike Denneman talks with Business Watch producer Kelly Leon about preferred stocks and what that means for your portfolio. Mike and Kelly.
Thanks, Peg. Hi, Mike.
Good morning.
So we've talked a lot about stocks over the years, but I've never heard you talk about preferred stocks.
Right.
What are they exactly?
Sure. So it's just one more type of security issued by a company and often thought of as a hybrid asset. It's kind of like a stock, it's kind of like a bond, and is kind of a blend of both of them. So it's got some unique characteristics. To go further, though, maybe back up and talk about first what's a stock and what's a bond, just to be clear. A stock, a common stock, represents an ownership interest in the company. If you own a share of common stock, you are a part owner.
Okay.
A bond, on the other hand, is at base a loan. If you own a bond from, say, Procter & Gamble, you have, in essence, loaned Procter & Gamble money. They will pay you that loan back with interest.
Gotcha.
So preferred stocks fall somewhere in between, and because of that, they've got, again, some unique features, and depending on what it is you're trying to accomplish with your investments, they might have a spot in your portfolio.
Okay, so that all sounds great, but there's always advantages and disadvantages. So what are the benefits to having preferred stock?
Sure. The one that comes first to mind, the one that is most appealing to many investors, is the high dividends that preferred stocks typically pay. It's not uncommon at all to find a preferred stock that's paying 5, 6, even 7% annually in terms of dividends, right?
Yeah.
So compare that to the typical common stock, which pays about 2%, and you can see that's quite a difference. And it's also true generally that preferred stocks don't fluctuate as much as common stocks. So if you're an investor who's looking for stability, this would be a good fit, probably. And then, I guess, lastly, I'd point out that the name itself, preferred, tells us something important, and that is where this asset falls in the hierarchy of the corporate asset ranking. In a very general sense, bondholders have the highest claim on corporate assets and income. Common stockholders are at the bottom of the list. So preferred stock tells us that that's one step above common, and that has some advantages, most prominently with dividends. If a company is going to pay a dividend, they have to first pay the preferred stockholders their share before they can pay anything to the common shareholder. So there's a little bit of a safety net there with preferred stocks that you don't have with common.
Well, that all sounds great. I think I should sign up, but I'm sure there are disadvantages too. What should I know?
There's always the other side of the coin, right? I guess first and foremost it would be voting rights. Common shareholders vote on how the company is run. Preferred shareholders have no say, so no voting rights there. And then also we mentioned the stability a minute ago. That's great if you're looking for something that's very stable, but if you're looking for growth over the long term, preferred stocks probably aren't going to provide that. And then I guess more in a big picture sense, today might not be the best environment for preferred stocks. And I say that because of the Fed and interest rates, which we know are going to be rising. So the last few years have been great for preferreds. With interest rates at historic lows, people who typically look to bonds for income have had to go elsewhere. Many naturally have gravitated towards preferred stocks because of that high dividend yield. Well, with the Fed getting ready to push rates higher, that's going to force those investors, again, to look elsewhere. So, again, while it's been a very nice environment for preferreds the last few years, the coming years might be a little bit more difficult. So I think the key message is you don't have to avoid them entirely, but just be aware of what's on the horizon and be cautious.
Okay. Great advice, as always, Mike. Thanks so much.
Thank you.